And thank you everybody for joining us at Creative Real Estate University. We greatly appreciate you coming. Again, Cassandra and Aaron, good to see you tonight. We have a special guest, and I've never met Jeanette before. This is actually Cindy's guest, but here I am talking, even though I have no voice left. But Jeanette, why don't you give us a little bit of history about who you are, how'd you get in the real estate game, and what are you going to talk about tonight?
Yeah, thank you very much. I appreciate that intro. Again, my name is Jeannette Horne, and I am in California. I'm in Northern California, just outside of Sacramento. And I am a licensed life insurance agent who happens to now also be in the real estate investing side of things. And I came into that last January through the Rain Facebook ad. I think a lot of people saw that and got involved. And at some point, just realized that the two worlds could come together and I could help a lot of people with what I was already doing with the real estate, or I'm sorry, with my life insurance license. So I have the license for the just general life and health, but I'm also certified in basically it's the family banking or the your family bank model or debt-free life model. And that is all just branding on top of what is a powerful infinite banking concept. And so that is what I've been using over the last several months to be able to help folks within the real estate world marry the two together and utilize the money to just further whatever their endeavor is, whether it be to get out of debt or also to be able to get more real estate holdings, to be able to PML and be getting more money on top of the money. So what I'm going to share with you isn't new. The concepts have been around for quite some time. And what I'd love to do is I'm going to go to a slide presentation, if that's okay, if I have share screen capability.
Yeah.
You do now.
All right, excellent. Thank you very much on that. So let's go here. And you can let me know if you can see my slides.
Yes,
All
we see
right,
it.
let's go to the slideshow view. A little bit slow because we're in Zoom, but basically what we have is the GUCI Money concept. Everybody says, what is GUCI Money? GUCI Money is guaranteed, uninterrupted compounding interest. And if you don't have it, it's definitely something you want to look at getting yourself some of. So really what we're doing is we're taking what the banks do already, right? When you put $1 in the bank, what happens to that is that they are actually able to then loan that same dollar out legally 7 to 10 times. So we put in $1, they pay us maybe 0.25 if we're lucky, but they're able to take that same dollar and they're able to loan it out 7 to 10 times. And that can be for a mortgage, for a car loan, for a credit card, for a student loan, personal loan. They're able to take that same dollar and leverage it that 7 to 10 times. So what this concept is me being able to show you how you can also take advantage of having your dollars work multiple times for you as well. This is just a kind of a chart of the real cost of interest. And so to me, it's one of the biggest bait and switches that we have. It's a great, again, marketing on top of this. So when folks say, I've got a loan, right? I've got a mortgage and my mortgage has a fantastic rate on it. Maybe it's 5%, maybe, nowadays it's a little bit higher than that. Even if it was 2%, what most people don't understand is that in the first year of that mortgage, typically the majority of that money is going to interest, right? So you're looking more at like, it could be upwards of 87% is what the interest rate is. And then over time, it's going to decrease. But let's talk about that, right? So in this example, this is a $300,000 mortgage, 30 years at 5%. And we're looking at it. It's the same static payment, that 161046 is going to be paid over the life of this loan. So you can see here on the right that in the first year, the interest being paid is going to be much, much higher. So then we're going to look here at year 20. Let's jump ahead, right? Let's jump ahead on this still. So that same 5% interest rate. And you're going to see here that now we've come up and we're paying a little bit less, but it's still at 42%. 42%. This is all the people that say, well, it's okay. I just refinanced. Well, you just refinanced and restarted that clock all over again. That's why the banks, they love it. Please refinance. This one shows you that it's taken us until year 30 of the 30-year loan to finally hit that advertised 5% interest rate. And this is not unusual, right? Most people I talk to, they don't sit down and look at the amortization table at the back of that loan, right? You get in to escrow and you want to sign all those docs and get out and get your keys as soon as possible. But in the chart, it is going to tell you exactly when this is going to be. And what I find is most people don't know. Do we think that taxes are going to be higher, lower, or stay the same in the future? This is a great question also, right? And along this line, I'm going to also show you that this isn't just me saying this. This is the US debt clock right here. This is up to date to the minute. You can log into this, usdebtclock.org. The only way that we can make money as a government, right, is to raise taxes. So I personally think that in the future, there is no other place for taxes to go than to go up. So with all of that said, oh, sorry about that. Let's take a look at the different ways that we have of putting money away. Okay, so these are just your typical. You've got the IRA or 401k, right? I have a lot of conversations with folks about those and what can happen. So on the right, you're going to see that this is the $41,900 if it is fully taxed. And actually, let's go back. So this is the same $10,000 investment over 28 years, 7% interest at a 25% tax bracket. This is the same 10,000, right? So if it's fully taxed, it's going to be 41,900. If it's tax deferred, meaning you're going to tuck it away in your 401k or tuck it away in your IRA, then that same 10,000 over time is going to be that 49,866. If we take this strategy though, and we utilize the GUCI money, right? We utilize the policy. We are now going to be looking at something that is going to allow you to draw from it down the line tax-free, potentially tax-free. And that same, what was 41,000 or 49,000 is now 66,000. So the question is, would you rather have $41,000 in the bank when you retire or $66,000 in the bank when you retire, right? So again, taking the infinite banking concept, it's been around a long time, right? We've known Nelson Nash, he wrote the book. A lot of people just didn't have the know-how to go in and dive in. Even a lot of financial advisors weren't able to tap into that because it was very complicated. But this is taking the concept and really breaking it down so that I feel most people can understand and take advantage of it. Not new. Back to that question. So this is the exact concept that Walt Disney used when he wanted to create Disneyland, right? He wanted to bring the parks into play. He went to the banks and the banks said, absolutely not. Talking Mouse Park, you're literally crazy. And we are not going to fund that. And so what he was able to do was he was able to tap into his whole life policy, the same concept to start Disneyland. Ray Kroc, right? Same thing with McDonald's. When Ray Kroc wanted to start McDonald's, he also was able to tap in and become his own bank. When the Kennedy family, when a baby is born, they also have, these are set up for them, right? They get one at birth, so they don't ever have to go to a bank. They're always going to be able to draw from themselves. The base bottom line of this is we are going to be leveraging a life insurance policy. So it is still insurance. You still have to go through that side of things in terms of underwriting and being approved. I can get very creative though. I can get very creative in helping people to put these in place. But it's really what happens is that the software, it's going to look and it's going to be looking for inefficient dollars. How are we using our dollars inefficiently where we can now use them more efficiently to benefit ourselves so that we can capture and earn on the same dollars multiple times, just like the banks do. The software is going to be looking for things like perhaps maybe you have a term policy that you would be better off placing that inefficient dollar into something like this. It's going to be looking for places where you potentially maybe you want to get out of debt. A lot of people out there trying to get out of debt as fast as they can in the way that they know how. So they're paying over. Are you paying over on your mortgage? Are you paying over on your credit cards, trying to get out of debt as quickly as possible? We're going to also the software will look for that, and we'll be able to utilize that towards helping you not just get out of debt, but be able to leverage the dollars multiple times. We're going to be able to take the cash value of the policy and allow it to work for you. So you're going to be able
Can I ask
to,
a question?
yes, absolutely, please.
Now you said you can be creative. So,
Yeah.
and I might be jumping the gun here, but it's going to be on my mind. So I'm going to ask anyways. So I have a UIL part. Is it UL or UIL? UIL policy. It's crap. It's crap. And I've had other people look at it. Oh, I shouldn't say I've had one other person look at it and they said I'm stuck. I'm literally stuck in this policy.
And when did you open that? When did you take it out?
I think 2 years ago.
Okay. You and I will have a conversation about that because I'm not sure why they're saying you're stuck unless the policy that you have, the particular one that you're in, involves some sort of a prepayment or there's some sort of a surrender charge that's associated.
Surrender charge. Yes.
Yeah. Let's look at that though, because sometimes, and I'm not going to say it's 100% of the time, obviously I don't know, I haven't looked at your policy, but sometimes if we're able to do as a rollover, like to like, so insurance to insurance, then you can potentially not have that be the case. I'm not going to say for sure because I'd have to look at it. What you can't do is we can't do a rollover from like people want to roll their 401ks into these or an IRA into this, and that doesn't work because it's not like to like. But you can do it with a policy to a policy. So let's take a look at it. Does that sound good?
Because I thought now I'm like, oh great, it's just a dead policy that I'm paying into.
It sounds like it might be a UIL, UL as opposed to an IUL too as well. And so let's break all of that down because I am not licensed to lose money. So let's start there. Let's back all the way up. I am not licensed to lose anybody's money. Everything that I do, I don't hold any of those certifications or those licenses. Everything I do is going to be indexed. Okay. So at the base bottom line of it, that means that it is going to follow the market, but it is not, your money is not in the market. Okay. So if I was to do something along that line and it was in an IUL, an indexed universal life, then your money would ride the elevator as things are great in the economy, things are going, your money is making money, you're getting more interest. And let's say something happens. We know it's going to happen, right? We know it's coming. It's not a matter of if, it's just a matter of when. The economy dips, takes a crash, stock market, whatever, all of that, your money on the elevator gets off on that floor, right? It's going to get off on that floor and it's going to wait for things to come back up. And then once it comes back up, your money gets off the elevator and it can continue to rise to whatever the top is for you. So in what I do, that is the case. You can't lose money. You can, some of the policies you can have a zero, right? You can just be protected, but you're definitely never going to go under that. But again, you and I, let's sit down and look at what you have and see what the options are. Does that sound like a plan?
Oh yeah, no, because if you can help me save, I mean, like I said, if you can help me, I feel like I'm just paying into it and nothing's happening. So,
and we don't want that either, right? We wanted to be able to utilize it. And I've seen like, especially after Green Live, when again, we were talking about like how Kelton was on stage talking about this GUCI Money concept, which really lit the fire for a lot of folks, especially real estate investors that I've been able to help. And I have seen some folks, and I don't talk negatively about anybody, but I have seen other people want to set these up differently. And there is a specific reason that I do what I do and the way that I do it. and I was trained. So I actually had to fly to Florida. I spent a couple days in Florida getting trained by Larry McLean, who is the Your Family Bank man, right? He created this concept. He was initially in high value wealth management. If you didn't have a lot of money liquid, if you wouldn't have a couple $1 million liquid, he wasn't even going to sit down with you, right? And so what happened was in the 80s, when the crash happened, then he was kind of trying to figure out what he wanted to do next. What was his next step going to be? And he'll tell you, he was sitting in Florida at a baseball game in the stadium. There's thousands and thousands of people in the stadium. And what he knew was he didn't want to chase the whale anymore. He didn't want to have to find that one person in the stadium that had $5 million liquid that he could go manage. He wanted to do something that he could help the majority of people in that stadium. And if he was asking the right questions, people would raise their hands. And so what he did was he took all of that knowledge and information he got from working with the wealthy, and he was able to then create a system that allowed him to be able to bring it out to the masses. And that's what I was trained on. I was trained by him directly. My company brought him in and his company, and we are the ones that have brought this out across the country, right? Started in Florida, been around for, I think they're probably in like their 12th or 13th year now, and now it's spreading. This is something that should have been taught to all of us coming out of high school.
I wish 2 years ago, before I signed this up, I was like, darn it, you know. I'll let you look at it and you can.
Yeah, we'll look at it, because this was his reasoning, was to be able to have us to be in a position where we can get the same tax advantages that the wealthy are getting, right? And also have control of our finances, right? To be able to have our money be our money. Like I'm working with a client right now she has struggled because in her family, they made the decision that she was going to stop contributing to her IRA, which was going towards her retirement, and do this instead, because this was going to be more beneficial and she would have more control over her own money. It's taken like I think we're probably in like week 6 for her to even access her own money. So just in that, this is always your money. It always remains your money, right? So as the cash value in the policy is growing, essentially what happens is that the insurance company allows you to collateralize it. You can collateralize the money. They say, okay, Cindy, you've got $55,000 we see in cash value, and you want to take out 20,000. Great. What we're going to do is we're going to loan you 20,000 from our money. So that's what allows your money to stay in the policy and continue to earn the interest, right? That's that guaranteed, uninterrupting compounding interest right there. And so all of this is to say also, take back the power. So it took a literal act of Congress during COVID, an actual act of Congress, for them to allow us to tap into our 401ks, right? I'm not lying, right? Is anybody following me on this one?
Yeah.
We had a shutdown economy. A lot of people weren't making any money, but a lot of people were also sitting on hundreds of thousands of dollars tucked away in a 401k that you can only borrow for specific things, first home, education. If you're under a certain age, you're going to pay penalties. You've got to pay interest and you have to pay it back. All of those things plus the taxes. So anybody who was able to borrow from that 401k in the end, then we had 3 years of having to figure out how you're going to pay the taxes back on it as well. Now, I'm going to tell you that act of Congress allowed people to do that. However, for my client, I'm going to say specifically, I have a client that he put one of these in place. He was one of my first clients, works in Hollywood, hairdresser. COVID shut him down, right? His income went to zero. Didn't know for how long, but what he was able to do was he was actually able to lower this, right? Because this is very flexible. He was able to lower his premium, keep it alive, but draw the money out to live on it. He was able to maintain his lifestyle because he had this in place already. And then again, what happened last year? Writer's strike. What happened then? His income shut down again. Same deal. Lower it, borrow the cash out, maintain lifestyle. And then once things open back up in COVID, and again, once the writer's strike was over, then he's able to now bring it back up and get back on track with that. So it's always still your money. I tell people, if you want to go to Paris Fashion Week and you want to fund it through this, it's your money to do with whatever you'd like to do with it. So it's very different. It allows that control. Does that all make sense?
Oh yeah.
Yeah.
Let's do it. Get my
Let's
money.
do it.
Like it's just sitting there, me throwing at it, and I'm like, I can't do anything with it. I just
Yeah,
did a bad policy.
And we've
That's what
actually,
it
and even coming back from, again, I reference Rain Live, and I
Yeah.
know not everybody was in it, but that conference for the ladies in the real estate investing world, I've had the opportunity to help several women already who knew what they wanted to do. So let's talk about PMLing, right? Let's talk about the power of this. Starting this, and hear me well, you don't have to do a lump sum up front, but they've seen the benefit. Starting this policy with let's say 35,000 up front and then a monthly premium, knowing that within the first 4 to 5 business days after it's approved and in place, you can draw out the majority of that, right? It's still a policy. There's going to be some cost involved, but to be able to draw out the majority of that and go PML it. So that's real life. So we had a real estate investor. She put in 35,000 up front. Policy was issued, and within that first week, she was able to pull 30 out to PML it. So let's go back. She's earning interest on the money that's still as though it's sitting in her policy, right? Because she's still earning that uninterrupted interest. But now she's PMLing it. She's able to PML that same money and earn points and interest on it. So then she's able to then pay herself back, rinse and repeat, do it again, all over again. So that's that ability for us to be able to do what the banks are doing, to be able to take our dollars and utilize them to be earning more dollars on the dollars. I will say that the conversation that I'm having now is a little bit easier than it was when I first started doing these like 5 years ago, because believe it or not, TikTok is helping. People are wanting to get these. They're not calling them GUCI money, but they're now understanding that there is a better way. We can pay less interest to the banks. We can pay less to other people. We can lower our tax liability, and we can utilize our money to put ourselves in a better position. And I think that that is very powerful, very powerful.
Yes. Oh
Does anybody else tell me any more questions? I love the questions.
Yeah. Everyone, you guys, there's only 5 of us on here. Everyone is missing this amazing. We're the only lucky ones. I feel like that we're blessed to be the only ones with Jeanette on it.
Thank you so much for having me. This is it. This is my passion.
Questions. I'm sitting here, I'm interrupting.
No,
you just sent us all up today.
Yeah. No worries. All right. Well, I'll let you go. Keep going on.
Yeah, no problem. Let's see what
I have a quick question, Jeanette.
Yeah.
So when we talk about having a money in a LLC, for example, and we're going out using it as a better option. We have that money that came from 401k, and we're using that as a PML. That money comes back. I'm not the beneficiary of that, so I can't benefit from it. So that money has to go back into that retirement account. But is the whole life, not the whole life, but the GUCI Money plan, is that different? I have access to that money, right? I can pull some of that money back out of that account for hardship or whatever. Right. Yes. So there is a difference.
So
there, right?
Yeah. So this is whole life. So this is a high value whole life policy. Okay. Participating whole life. It is very different than your grandmother's whole life policy. Okay. So I'm going to tell you a little bit about that. Had another Rain sister. When she started Rain, wanted to get that initial $19,000 or $20,000 to start, thinking she was going to borrow it from her husband's whole life policy. But when they looked at the policy he'd been paying on all those years, there was nowhere near $20,000 worth of cash inside of it. This is not that. Okay. This is a high value. It is designed to build cash as quickly as possible. So very, very different. Yes, you also have control over that. You don't have to pay yourself back here. How about that one? I don't know why you wouldn't. It doesn't make sense to me not to, but you don't have to, right? You can borrow that money out and decide, you know what? I'm not going to pay myself back. I have folks that are using this as their long-term retirement plan. Clients paying in monthly, they're going to do so until 65 and they're going to let it ride. And then they're going to start drawing income on it at whatever age they decided, 71, 72, whatever. They're going to draw an income with no plan to pay it back. So you've got a guaranteed interest rate going on this side, right? You're getting paid. That's the uninterrupted part of that compounding interest. It's compounding yearly and accruing monthly. You've also got dividends that are getting paid. So those are not guaranteed, but the company that I use has been around for 120 years and has never missed a dividend payment. Okay, so take that as you will. You're getting paid interest and you're getting paid dividends on this. So at some point, which I love to share, this is it, right? Once we do the real numbers for you in your particular situation, and I show you the break-even point, at some point you're cooking with grease because the amount of money you put in is going to be less than the amount of money that you can take out. The cash value will overtake it. So that's why these are so powerful, right? Does that all make sense?
Makes sense.
Yeah. Did that answer your question?
Yes.
Yeah. And it doesn't have to be a hardship. This one, you don't need permission. You don't need permission to borrow it. You don't
So
need
much more
permission to pay
flexibility.
that.
So
Huge
much more.
flexibility. You can, even like I was sharing about my other client, I always tell everybody what their minimum is. Like you have a minimum that you can flex it down to keep it alive. You want a little more cash flow at Christmas, whatever the case. You're going on vacation, you want a little more cash flow, you can flex it down. And then you always have the ability to bump it back up, right? One of the important things I will share is I can do these with a couple of different companies. A lot of companies don't do this at all. A couple of the companies that I have, they allow me to do it or allow us to do it, but they don't really want to know. They're like, yeah, we know you're doing it, but we don't tell us. And then there's the company that I choose to use, it's all very transparent. It's actually a box on the application. Did you use an infinite banking concept? Did you use basically a GUCI Money concept? And you check that box. They know. They have a dedicated department of people that know why we do this and understand it to be able to answer those questions on the back end. Sometimes you're going to see other companies that maybe they do offer this. Again, I could write other people, but this is the question. One of the questions I would have you ask if anybody else was presenting this to you is, some companies, once you're paying in, let's say your premium is $1,000 a month and you want to flex it down because you want more cash flow for a few months. Over a certain amount of time, what they will do is they will then lower your maximum to whatever that was, right? So let's say it was $1,000 a month and you go, I want to only pay $550. I'm going to pay $550 for a while. And you lower that down to $550 and then you go, I'm ready to put $1,000 back into that again. Well, you can't, because now your new maximum is $550. Okay. And in order to get it back to 1,000, some of the companies will make you come and maybe you'll have to do a new medical exam. Maybe they're going to reevaluate. Maybe you've had a health challenge. You're also now a little bit older, so it's going to build cash a little bit slower. So all of those things I say to tell you that I'm very specific about the company that I use. It's very transparent. You can flex it up, flex it down, super flexible as many times, as often, as long as you want. It's always going to be there for you. And the other part of it is, as long as you stay within the parameters, like we put in the guardrails, and we know we're going to try to keep you out of tax liability on this. Okay. So this isn't one of the ones where we put it in place and I go, fantastic, see you later. This is one of those ones where we put it in place and we link arms and we become family for many years to come, because we're going to be borrowing, doing the loans to do different things in real estate or whatever that's coming up with this. We're going to be wanting to pay it back if we're going to choose to do so. All of that is me being able to help to guide you along the way. I'm going to show you how to do it. I'm going to empower you with, here's the paperwork. This is how you do it yourself. Here's the website. You can see everything in real time. But on the back end of it, I'm also here, right? Most of my clients just, even if they want the loan, they'll text me or email, need $10,000. Can you please process? And then we just do a DocuSign. So that's kind of how this all works. Again, it is a policy though. And so there is that life insurance part. So you have to be able to be approved on that side of things. So some of my first clients, the family, they were in their 70s. And when I went to do some mortgage protection with them, I realized, well, they didn't need mortgage protection, but what they wanted to preserve a legacy for their kids. So they have a business. They help developmentally disabled adults. They had a house, beds in their own home. And then they had another residence that they also had beds and worked from. And when I started to look at their just debt information, really is what it was, I saw that they were in a lot of debt. So they had credit cards, business, personal, vehicle, personal, business, vehicle. They had the 2 mortgages, and they had kind of that whole thing. And when I asked them, asking questions about how much they owed, they had thought that they were in debt. They said about 800,000. And that's what everybody tells me. That was their principal, right? That's just principal. My software is got the algorithm that's going to run it, and it's going to give you your true debt. So I always make sure everybody's sitting down also, because that 800,000 was actually close. Is like $1.45 million was really what they owe, because what the algorithm and the software does is it calculates the interest over time. So if they had continued to go on the path that they were, and she was 76, he was 74, it was going to take them 27 years to get out of debt. 27, again, 76 and 74, right? So what we did, and this is where we get creative, was I was able to do this we borrowed their healthy 40-year-old daughter's age and her health, essentially. So she became the insured person. Her parents own it, and they're using it to get out of their own debt. But because we were able to utilize and get creative and use her as the insured person, then their cash value grows much, much faster. So the only caveat on that is just having folks understand, then of course the insurance portion of this is on her. So it would be on her life, but we're not putting these in place for the insurance. That's kind of the side benefit that
use our kids.
Adult children. That was it.
Darn
Their
it.
adult daughter, not adults. Works a little bit differently. Yeah. But then we can look at being creative. We look at the full picture. Sometimes one spouse is healthier or younger than the other. Sometimes we'll split them. There's all kinds of ways that we can do this to basically enable us to do one for almost everybody. Does that make sense?
Yep. Yeah,
All
I have policies on everyone in my family. It's just they're not the right policies. They're just,
We're going to do a deep dive for you, Miss Cindy.
They're definitely not.
Yeah, we'll do a deep dive.
I just watch the money go out, but I don't think anything's.
Deep dive.
Yeah, I need a deep dive. Let me tell you, I need a deep dive. I need a lot of help.
We'll do it. That's what I'm here for. Anybody else have any questions? No? Okay. So the next step is really, as I shared, when I show you your own numbers, that's when it clicks. I can be very theoretical. I'm actually going to, let me see if I can pull it up. I'll show you a real one. And you can see what I'm talking about here. Try to share the screen again. All right. And then you guys can let me know and you can see it.
Yep, we see it.
All right, so this is real. Let me make it a little bit smaller though. Can you guys still see it?
Yep.
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 Okay. So this is a real person. And this is the debt. And this is my cousin. He's good with me sharing. So that's the beauty of this. So when I went to sit down with them, we went through and we plugged in the debt. And what you're going to notice for their debt is they don't have a mortgage. Okay. So this debt is all based in credit cards, and they have a motor home. So that's where this is. So the column you're seeing here, I'm trying to get it all on the screen for you, is the far left is the balance owed on all of the debt combined. Then you've got the interest rate and the monthly and all of that information. So you're going to see everything. Actually, let me back up one more. This is the real debt for him. So again, if I'd asked him about $250,000, he would have said, but once it tacked on the interest, the real debt was a little over $300,000. And it was going to take them a much longer period of time to be able to pay this off. It was going to take them a lot longer to pay this off. So you can see, this is what that debt picture looked like. So then we come here, what we know is by taking this, that 8 years and 1 month that it was going to take them to get out of debt, bring it down to 2 years, 2 years and 8 months. And can you guys see on that far right bottom column, we're going to also save $15,000 in interest. So sometimes what happens is people, they freak out on me. They go, you know what, but I've got this card and I really have to pay it off, and, or whatever the case is. But what I will say is, like we talked about, your money is always your money. We could do it in whatever order you want, but the software is going to kick it out to say what is going to be the most beneficial route for you to save the most interest. Okay. So we can always change the order, but it is going to first and foremost take it to be able to save you the most. So in his instance, $15,000 is what we're going to save by following this pathway. And then also being able to get out of debt in 2 years and 8 months. So are you willing to pay things maybe a little slower than you thought mentally? Like people are paying over on cards, which is now giving that power and that money to the bank. If I could save you time and interest overall in the big picture, right? So that's the mental shift. 401k is a mental shift. I have a lot of clients that have a 401k and they say, oh, but my company matches. Fantastic. But what I also want you to understand and make sure you know, because my job is to put you in a better position after we talk than you started, that even when your company is matching, right? So you're contributing and your company is contributing. Your company is getting a tax break because they are contributing to the 401k. Mm-hmm. You hit retirement and you go and you're ready to pull that money out. You're going to start living on it. You are in fact going to now pay taxes on what they contributed also. I want everybody to understand that.
Those bad people.
You're going to pay taxes on what you put in and on what they put in. Most people don't know that. When I came back from the training, I thought that I was going to share this concept with everybody I could, large companies, small businesses. I was like that person that had my first mild heart attack and discovered working out. I was sharing it with everybody. I thought everybody was going to want to do this. But when I started approaching companies, they didn't want to talk to me and I didn't know why. So it took me a while to finally have it explained that they get this tax incentive, these companies, to have these things in place. So no, they didn't want to offer this as an alternative. I thought, hey, they're going to love to have this alternative. Your client or your employee can have a 401k option or a GUCI Money option, and they can pick. And they were like, absolutely not, because they're gonna lose money on that in that way. The other thing is, go ahead.
So as your clients now, so I contribute to my 401k, right? So are your clients they're stopping to contribute to the 401k and they're contributing to their GUCI account?
Every instance is different. So my best friend was the first one I did one of these GUCI monies on. And in his instance, he didn't want to take the tax hit. So he didn't actually pull out his 401k money to put it here. He did what you're saying. He stopped the contribution and put that contribution here instead. I have other clients though, that I have one right now. They take a look at wherever they are, maybe the tax liability, talk to your CPA. I'm not a CPA. And they make the decision to say, but you know what? This year I'm okay. And I'd rather take that tax hit right now. And I want to pull that money out and I want to move it somewhere I can use it. So everybody's situation is different. We just take a look at what's going to benefit you.
Got it.
Yep.
Okay.
But that's the
I
one.
just learned something. I just learned something seriously that I'm a stupid company taking pay taxes on the money they give me. That's BS.
Yeah, you're gonna end up paying taxes on it. And the other part of it is to me, the 401k is also a moving target. Right? We don't know how much you're going to actually have in there once you go to retire and to pull it out. Like we have no idea. Nobody has any idea because the market is going up and down all the time. And we've also all agreed earlier that taxes are going to go up. So it's also a matter of weighing out, would you rather pay the taxes now that you know, right? Set this up and going forward, you have the ability to have the gain not be taxable. Or do you want to play Russian roulette and go to retirement wondering how much you really actually are going to have in there and what that tax bracket is going to be? Does that make sense?
Yeah. Now I have another question. So this is your cousin. He's living large in his, mobile RV, right? And I know he's trying to pay down his debt, right? But isn't he going to have more debt over 2 years? Like he's going to have to go to the grocery store. He's going to have to go,
That stuff is not included. Yeah. And it's a mental shift. Okay. So even the clients that had the beds in the homes that they helped the developmentally disabled adults, she freaked out on me because of what you're saying. Like, what? You're going to make me cut my credit cards and all the things. I'm like, okay, first of all, you don't have to cut your credit cards. Your credit cards are yours. But what I'm going to tell you is this is a mindset shift. Instead of reaching for the credit card, and I'm not talking about groceries, like they have that accounted for on a different account. Okay. But the automatic reflex of I need a car, let me get a bank loan. I need to had a medical emergency. Here's my credit card. We want you to borrow it from here instead, because now you're paying your own bank, your family bank. You're going to then borrow it from your own bank of yourself and then pay yourself back that money and that interest that you'd be paying to somebody else. Mindset shift. So even though they've got all of this stuff that we're paying off in order, just like I shared about my other client in Hollywood, this is living, breathing, flexible. Get off course and you go, oh, you know what? Instead of paying off Wells Fargo, we're going to go on vacation. Fantastic. Then it just makes it take a little bit longer. It's always still your money.
Yeah. So, okay, I'm like taking over the conversation here. Sorry, Aaron and Cassandra, but, so like, say I have a policy, right? And I'm ready to go. And I have this, like I have an RV too, right? That most of the time just sits, doesn't do anything. We're not selling it. So can I take that money and go pay off that RV like today and just use that as instead of using that as the bank? Does that make sense?
Okay. I think you lost me in your example.
Instead of the loan, like I can, and so I think I owe $30,000 on it. So let's just say I have $30,000 in my GUCI account. I can go take that $30,000 and pay off that RV and pay myself the interest to me.
You can. So what would happen essentially, and again, we would run it through to see what's going to be the best route for you in terms of the software. But in this instance, if that makes this most sense, what we do with this is, even in these, we take whatever the payoff is for that month or for you in that big lump sum. And then what would happen is, instead of paying whatever the entity is, the bank or the bank that you have the RV loan through, you would pay yourself back that monthly. You would take the monthly payment you're paying and take that payment with the interest and pay yourself back with it.
Got it.
A lot of the ladies, though, in the rain or doing this for the real estate side of things, what they do is they don't pay themselves back monthly. It's almost like I have two different buckets. I have the buckets of the real world people that I deal with that are doing this to get out of debt and build that tax-free savings retirement account. Then I have the entrepreneurial real estate people that are using it on top of all of that to also do the PMLing and flipping and all of that. Okay. So in that bucket, I have most of what the people are doing is they borrow that out and they PML it, and they don't necessarily pay themselves back monthly. They'll wait, like, let's wait till the PML gets paid back in full. Then I'm just going to take a lump sum and I'm going to pay myself back totally and then do it again. And it's flexible. You can pay yourself back monthly and then decide you want to pay all the rest off. Great. We can do that too. You can be paying it off in every 3 months and then decide that you want to scale it back to monthly. We can do that. The flexibility of these, I think, is the biggest part of this. It can be living and breathing and moving and flexible and getting bigger and getting smaller as long as we stay within the parameters. So that the IRS, it's a tax code that it tells us that we are able to use a life insurance policy towards retirement, which is what we're doing. Okay, the tax code tells us this, just most people don't know. The only thing we can't do is we can't shove more inside of it than it's designed for. Okay, so sometimes I'll have somebody say, well, I'd like to set one of these up for, I don't know, $500 a month. That's going to be my premium. And then they get in and then they see it working and they're paying stuff off and they're getting excited. And they go, man, well, I'd like to put $1,500 a month in there now. Well, we can't, right? I mean, sometimes there's some room, but it's going to be designed to be the bucket can only have so much poured into it. If we go outside of that and we try to pour more in, then it does what they call a MEC, a modified endowment contract, which you don't have to know. But what you will know is that then the IRS wants their money. Okay. So now you're outside of my guardrails. If we stay inside of that, though, and you'll know your minimum number, I give you that. You'll know your maximum number, I give you that also. Stay in your guardrails and you're good to go. This is also not a get rich quick. Okay, so this is not that. For some reason, I get a lot of people that think they can set these up and then draw off the death benefit. I don't know where that miscommunication lies. We're drawing from the cash value, which has to, build up or get put in, and then we borrow it out, but it's not the death benefit side of this. So it's not a get rich quick, and it's a long play. So if you decide, I don't want to do this anymore, then you also open yourself up to the potential of a tax liability. If you get to the other end and let's say retirement, and we're going to have very specific, like I said, we're going to be arm in arm through this journey. You're going to have specific instances of policy loans to yourself, which loans in our country are not taxed, and withdrawals at some point. But if you just go, hey, I'm retired, I have 3 million sitting in here, I'm going to withdraw all of it. Well, that's going to also create a potential for a tax liability because we always want to keep the policy intact. Let me show you this. I think that he should pay me maybe also on this. Let me see if I could find it. This is not mine. I don't know this man. This is a book. It's an Audible. Okay. One of my clients said, hey, after I met with you, I read this book and he says everything that you say. And when I listen to it, he says everything I've been saying for years. It's only like an hour and 20 minutes, quick Audible read. You're going to be blown away. Okay. It's going to explain everything I've said and then give just more instances of the power of all of this. So if you want to take a screenshot or jot that down, I highly recommend this Audible.
You change the screen, Jeanette, because we're still
see
on
it.
that.
You can't see it. Okay.
No.
Yeah. Let me stop share and share again. Okay. Can you see it now?
Oh, yeah. I'm gonna take a picture of that.
Yeah. This one is really good. Really, really good. And he should pay me. Like I said, I sent more people to his Audible probably than he's had in years. So, and again, he just does a deep dive into the why. He does a deep dive into the understanding the history of the banking system in our country. There's other books out there as well too. You can grab the Banker's Code and all of the ones. This one I just recommend because it's such a short read and it's very it's bite sizable, right? You can really, I got this one in on the treadmill and everything I was listening to, I go, exactly. That's exactly right. That's exactly why I say what I say. So I just love being able to share this, my information, as well as just letting you know that it's not just me, right? It's not me telling anybody anything. This is me just sharing all of the information that's out there. We just don't know where to find it. Mm-hmm.
And we appreciate you for that.
And I appreciate you having me. Any other questions?
Oh,
So again,
I feel like
in the real estate world, and I'm trying to wrap my brain around this because we do a lot of loaning out for different deals, right? So we have fix and flips, short term, maybe 3 month if we're lucky. 6 months is quite typical, maybe 12. We take $40,000 or $50,000 loan out, and we'll get, whether it's to ourselves, right, our own entity, or other friends like Cassandra or Aaron will loan out $50,000 for a project. At the end of that, they'll turn around and pay us back 65. Great. We can do that all through this model.
Yes, you could do it all through this model.
So and it doesn't have to be monthly payments. It can be at the end of that project and come back as one big lump sum.
100%.
Okay.
Yep. The only thing you can't do is put more in than it's built for. But we also, like, if you know that you're going to want extra room inside of it. Like, let's say we build it for $2,000 a month, but you know what, maybe 6 months down the line, a year down the line, I know that I'm going to want that 2,000. Yeah, but I'm going to want to really put $3,000 in. What we do is we set it up for 3,000 and then you flex it down to the 2, knowing you can go back up to that 3 whenever you want to, or never. It's like totally up to you. But you have that flexibility. The other thing we do also is what we can build. Typically, we can build some room. Like I have some folks that go, I get a bonus from work every year, or I want to put my tax-free fund inside of this. So it's not every month that I want to do this, but I want to have the ability to at least put a little bit more inside. We'll build that room in there also, so that we can have some space so that the bucket isn't totally full just on your monthly amount. Yeah, absolutely.
I appreciate it.
Yeah, for sure. Cassandra, Aaron, do either one of you questions?
Honestly, I just want to collaborate with you and network with you. The reason why, because honestly, we're essentially competitors if you think about it like that. I do the same thing. I just came from the longer background of being in real estate and having deal flow. So that's actually why, even though I have actually a really long history in insurance, I've never really went down the life insurance side, but I realized I can provide so much value to my lenders if I'm able to help them structure these policies. So I just came in to collaborate with you and, see what you got going on. I love the way that you guys put that together. So great work. And hopefully I can just touch base and we can network one-to-one.
Yeah, absolutely. I look forward to
Excellent.
it. Yeah. But you, Aaron, questions?
Not that I can think of at the moment. But I just put in the chat to get your contact info. Definitely something I'm interested in.
I'll put it in here, right here.
Okay.
Yes, how can people reach out and get in touch with you?
This is my best route of communication would be text message, but then also I'm going to put in my email address as well.
Do you have like a booking platform, Jeanette, where people can hop on your calendar?
You do, I do, but I am balancing the 2 businesses at one time right now. And so reaching out to me directly is just so much easier right now. Yeah.
Excellent.
Jeanette, And everyone asked me if I have a calendar link, and I said, you know how many calendars I have? Like, they don't
Yeah.
sync up.
They
So
don't
I'm
sync
like,
well.
yeah, I'm like, Jess, I'll put you on my, whatever, I'll put you on my calendar when I have
Yeah.
availability.
I'd
Yeah,
rather
it's-
like, does this time work? Let me put it on my calendar.
Yeah,
100%.
yes.
Yeah, it's no problem. And typically, if you look at my Calendly, it's going to have way fewer opportunities of slots than if we just communicate directly, because then I know about how long it's going to take and I can slot you in.
Okay.
Mhm.
Yeah, this was great.
Yeah, thank you. I'm excited to help. That was my thing, right? That my passion. Funny enough, I started the real estate investing side, and I share this with a few other groups in the Zooms. Is I started that to stop doing this. I started that to stop doing the life insurance. Like that was my out, because
Yes.
I was dealing with people that were in kindergarten level. And so I would have to explain so much to get them to understand why one of these would be beneficial. Like I'll tell you right out. When I came back from training and I was so excited, I tried to tell friends and family, and outside of my best friend, no one did it. No, people ask me all the time, well, how many people do it? Do you know in your own family? No one, because they would rather be prideful and not share maybe their true financial picture with me than allow me to go in and help them. And then I see them go fund me on Facebook. It happens in real life. It really does happen. Somebody I could have helped get, in a better position doesn't want me to see maybe their credit card debt or their student loan debt. And now they want me to give them money in a GoFundMe. My whole point is helping people get to a place where they don't need to have to do a GoFundMe. They can draw from their own bank, from their own cells, to be able to even help others or help their family or whatever that is. So with all of that said, that I started Rain to stop doing that. I didn't want to do that anymore.
Well, at
And
least now you have people that understand what you're
so
talking
different.
about. And
Yes.
So different. And having Kelton get on that stage at Rain Live in July and shout GUCI Money from the stage for 4 hours,
Mhm.
huge difference. So now
You're
I'm
like,
dealing
I
with
saw
people that
that.
get it.
Yes.
People were
Yeah.
throwing them like, I want
Yeah.
it, I want it. I'm like, well, I can help. And I wasn't going to share then either. What's funny is in Northern California, I joined in January. At the end of the month, I went to one live meetup at someone's house. And when we did the meetup, we kind of went around the room just explaining what we did and how we got involved. And I'd shared, this is what I do. And so when we were at Rain Live and he was talking about GUCI Money from stage, she happened to be sitting in front of me, and she turns around and she says, that's what you were talking about. I was like, yep, that's exactly what I was talking about. So she,
That's
the
awesome.
one, she told me to share, and that's why I'm here. So I am available. Again, just reach out to me directly. It's probably the easiest route. Get you scheduled. We do the one-on-one. I show you your own real numbers. Then it all just makes sense.
Yeah,
Yeah.
that sounds great.
You'll probably be needing like 2 hours with me, because mine's like a long list of everything going through.
We'll
I should
get it
probably
done.
just share my policies with you.
That's going to be part of it. Yeah. You could, if you want to do, I'm going to send you the forms, and there's a form. So if I can send it to you, Cindy, it would be great. There's a form that you fill out, and that's how we get all those numbers plugged in. And
I'll
so
give
if
you
you
my
have that
account.
already done, then it makes the second, our first one-on-one time will be better. It'll be more efficient.
Yes, send me that information and I'll try to get it to you. Mine's
Okay.
with American, I think American something, and I logged into my account and it was their heart, I don't know, the policies aren't there, and who knows? It's more of a
We'll
pain.
deep dive it.
Yeah. Maybe I
Yep.
should just pretend you're me and call them, because they're all over the place.
We'll figure it out. And sometimes I have the right question to ask that tilts it into the favor of you getting the actual information.
Yeah.
We'll just speak their language.
Okay.
Yeah.
Sounds good.
I love it. Thank you guys.
All right. Thank you.
Have a
Thank
great
Thank
you.
you so much.
Bye, guys.
Take care.
Bye, guys.